Welcome to the Louisiana Forestry Association's webinar, our Hurricane Timber Losses Tax Deductible. We'd like to thank our sponsors: International Paper, Crosby Resource Management, Southern Loggers Cooperative, St. Lucia Plantation, Theus Grisham Davis and Lee, LLC, Weyerhaeuser, Bar Land and Timber, Canfor Southern Pine, Kroll Forest Resources, LLC, Despino's Tire Service, Mulpus Woodlands Group, Packaging Corporation of America, Slaughter Logging, LLC, Louisiana Forestry Foundation, Ann and Joey Allen, Trey and Carrie Allen, Baker Forest LP, Bennett Timber Company, Hood Industries, Betty Hughes, Muslow Forestry Incorporated, Reimers Company, Resource Management Service, Soterra, Southland Spray Service, and Young Estates. Our presenter is Paul Spillers, a tax attorney and estate specialist. He practices in Monroe, Louisiana with the law firm Theus Grisham Davis and Lee. He is a regular presenter at forestry forums on tax, estate, and forest income issues. Paul is a tree farmer and a member and past president of the Louisiana Forestry Association. This webinar is being recorded and will be available on the Louisiana Forestry Association website at a later date. For those viewing the live presentation, look at the bottom of the screen and you'll see a Q&A button. Click there and you can place your questions. We will try to get all of them answered, or as many as time allows. This webinar has received a Society of American Foresters CFE 1 credit hour and a Master Logger continuing logging education credits of 2 credit hours. And now we welcome Paul Spillers.
We're delighted that you chosen to spend the next hour with us, and we hope we'll present you with information that will be of help to you if you have land or timber that has been damaged in the recent hurricane. Before I get into the presentation, there is a disclaimer that I need to make, and Buck, if you could advance the slide. There's a disclaimer at the bottom of the slide. Today's webinar presentation is education. It's not intended as legal or tax advice, and we would suggest that you consult your own tax advisor for the proper application of the law to your particular situation. But again, we're delighted to spend this time with you. And again, I wish to extend my thanks to our sponsors, who we could not put this on without them. So thank you, sponsors. Now let's begin to take a little look at the recent hurricane that came through. Hurricane Laura did a tremendous amount of damage in this state. Estimates range in excess of $1 billion. That's a number that is so big, I really can't get my hands around it or my mind around it. But think of the local landowner, Terry Thibodeau from Breaux Bridge. Terry has a nice little job in the oil patch, but over the years he's accumulated some timberland, and he's got approximately 80 acres of land that has been growing timber, and he's been managing it. His intent was that that would be his retirement nest egg. Well, everything was looking great until Hurricane Laura came through, and now Terry Thibodeau's retirement nest egg is no more. So it's presented a serious problem for lots of landowners and consulting foresters in this state. So we're going to be discussing some of those issues, how we can best deal with some of the tax issues associated with those damages. Now, help will be available from various federal and state agencies. However, I'm not going to attempt to cover those. That's not my area of expertise. What I'll be trying to help you with or get you to think about are some tax savings pertaining to casualty loss deductions. That's a federal statute dealing with that. So that's what I'll be dealing with here today. Now, before we jump into the meat of the program, there are certain definitions that we really need to get on the table and get a good understanding of before we jump into the meat of the coconut, so to speak. The first is, what is a casualty loss? The law uses that term in a very specific kind of way. So a casualty loss for our purposes is something that is sudden, unexpected, and unusual. Something sudden, unexpected, and unusual. Those are three requirements that we need to satisfy, and it needs to be physical damage to property. Well, the question you're probably raising is, well, what about this hurricane? This hurricane, does it meet the definition of sudden, unexpected, and unusual? Some of you may think, well, we've had 2 or 3 hurricanes in the last year, so maybe it's not that unusual, and we might flunk the test because of that. However, the good news there is courts have looked at this question, and courts have ruled that despite the fact that we have a lot of hurricanes in Louisiana, despite that fact, a hurricane meets the definitional requirements for sudden, unexpected, and unusual. So the bottom line is, if you have hurricane damage, it meets the definition. And it's certainly physical damage to your property. So we've got that issue there satisfied. Moving on to the second requirement, there has to be business property that has been damaged. Now, the term business, we need to think about that, because that's again, a term of art. If you're in the business of growing trees, you need to have a profit motive and some active management. If you have a profit motive together with active management, then that satisfies the definition for business property. Now, some people own forest land that is not actively managed. In fact, a lot of people own forest land that is not actively managed, and therefore that what we would call investment property, not actively managed, would fall outside this definition. So if you're an investor who's not involved in active management, your hurricane damage may not meet the definitional requirements for business property. So that's an issue that you need to be aware of, and to try to make sure that you're in the position to argue, at least, that you're actively managing your property. If you're using a forester, that's great, because foresters help you active manage your property. But if you don't have a forester and just bought 40 acres of land out in the country, perhaps for recreation, you didn't really think too much about growing trees or have a profit motive growing trees, you may not meet the definitional requirements. So that's something to pay attention to. Now, the next area of definitions deal with timber tax basis. Now, those are terms that are extremely important to this presentation. So we got to get a good handle on these concepts. There are 3 types of timber tax basis. The first type is what most of us would have, is something called cost basis. When you purchase your property, if you're purchasing land and timber, you want to make sure that you allocate as much of the purchase price to the timber as is reasonable. And of course, hopefully you got your forester there helping you to allocate in your contract. He's allocating the the largest amount that's reasonable in your purchase agreement should be allocated to your trees. Allocate as little as possible to the land. Now, the reason we do that is we will learn we want tax basis in timber. And if we have tax basis in timber, that's going to put us in a position to take advantage of some deductions that'll really help you. So the game that we're playing here is we want to maximize tax basis in your timber. Now, the second type of basis is something we call carryover basis. Let's assume your parents bought some property and they owned it for a while, and then they donated that property to you. You're the donee, your parents are the donors. So if your donors have a low tax basis, when they gift that property to you, your tax basis is carried over from your donor parents to you, the donee. There's no step up in basis. There's no adjustment of basis. It's simply whatever your parents' basis was, that's your basis. And we call it carryover basis. Now, the third type of basis is where we can really begin to do some good. It's called stepped up basis. And here's the idea. When someone dies owning property, the value of that property at the date of death, the value of the property at the date of death becomes the heir's tax basis. So let's assume we got parents had timberland that had very low basis. Parents die, so whatever the fair market value of that property is, the heir's basis is stepped up to the fair market value on the date of death. So the heir takes the property, takes the land and the timber, having new basis equal to the fair market value of the property as of the date of death. Okay, and this is an extremely valuable provision in our law that a lot of people don't take advantage of. And you need to make sure if you've received property from an estate that you get adequate valuation as of the date of death to properly step up the basis to the fair market value as of the date of death. Very, very important. Okay, moving on to our last topic on this slide is extremely important slide. It deals with something called single identifiable property. Single identifiable property, also known as SIP. Okay, now this is a concept that you need to get used to because it can really do you some good. Now, a single identifiable property can be one tract of land. It can be one tract of land because that's a single identifiable property. Okay, so one tract of land and timber on it can satisfy the definition. However, we can't stop there because the concept is much, much broader than that single 40 acres or that single 100-acre tract. The concept includes multiple tracts of land comprising a single block of land. Okay, now let's talk about this just for a moment. We have multiple, let's assume you have 4 tracts of timberland. Each of those 4 tracts are single tracts alone, but if you put them all together, if you aggregate those 4 tracts, those multiple tracts can be considered a single block of land. So think of it this way: if I have water, one cup of water, that's a single identifiable property. But if I buy a 6-pack, it's still a single block or a single piece of property simply because I'm packaging it together with other tracts makes it a single block. So whether it's 3 tracts or 5 tracts or 10 tracts or even more, if you aggregate in your accounting, if you're aggregating all of your tracts of land into a single block of land, then that's called a SIP, or a single identifiable property. Now, why am I spending so much time on this multiple tracts comprising a single block? Why? Because tax law says that I get to take advantage of not just the basis of one tract, but I get to aggregate the basis of all the tracts of land in that block. Now, a little history here, I think it's important. Westvaco, one of our sponsors, who I think the successor of Westvaco is one of our sponsors, West Rock, in fact, and West Weyerhaeuser, those two companies years ago dealt with this concept, or proposed this concept, or advocated the concept, and they actually took it to court with the IRS, and the court ruled in favor of Westvaco and Weyerhaeuser. What Westvaco and Weyerhaeuser were doing, they were aggregating all of their tracts of land into large blocks of land, and then aggregating the basis of the properties in this block. And by so doing, they had utilization of the tax basis of all of the single tracts within the block. So by aggregating these tax bases, they could deduct and deplete the basis sooner than you would otherwise. Okay, so we can thank two of our sponsors for advocating and proposing this concept probably 30 to 40 years ago. And the IRS finally came along in 1999 with a revenue ruling that embraced and agreed with Westvaco and Weyerhaeuser's position. So this concept of SIP, single identifiable property, is available to all landowners, not just the big corporations. But if you're an individual landowner who owns several tracts of land, you want to think about aggregating those tracts so that you get the advantage of more tax basis. Okay. Okay, moving on to the next slide. This is the critical slide that defines how much of a casualty loss you can deduct. Okay, very important slide. The deductible casualty loss is the lesser of two amounts. Number one, the decrease in the value of your single identifiable property. Okay, so it's the decrease in value. That's the first number. And the second number is, what is your aggregate tax basis of the single identifiable property? Okay, so two numbers. What's the decrease in value? What damage did you suffer to all of your property that's in the SIP? And secondly, what is the aggregate tax basis of the SIP? And you get to deduct, not the bigger, but you get to deduct the lesser of those two numbers. Okay, so by adding and aggregating tax basis, we get to deduct a lot more value that has been diminished. So this aggregating concept will come into play here and really put you in a position to have a much greater tax deduction if you're aggregating the tax basis using this block system. Now, there is some legislation that is proposed that's in Congress. I don't know if it'll go anywhere. It's been languishing in Congress, I think, for years, that would allow for the deduction of the entire decrease in value. But that Proposed legislation is kind of stuck, and I'm no assurance it'll go anywhere. But if it would go, then that would be a big benefit for forest landowners, because then it's simply you get to deduct the diminished value. You don't have to worry about the tax basis. But that concept is probably far in the future for us. Okay, at this point, we've kind of covered the basic concepts, the introduction to the language. Now let's see how we can apply what you've just learned, okay? Example 1, Jack purchased 40 acres of land years ago and has made several management thinning over the years. The thinnings have depleted his tax basis. So Jack has no remaining timber basis. But the timber value before Laura was $2,000 an acre for a total value of $80,000. After Laura, the value was zero because it was totally destroyed, no salvage and no insurance. So Jack's damage is how much? $80,000. The reduction in value is $80,000. That's real money that Jack no longer has. But what is his tax basis? Jack's tax basis, remember, he'd been depleting this property. He'd been depleting the basis with thinnings. So his tax basis, when Laura comes to calling, is zero. So the result, deductible loss, is zero. It's the lesser of the tax basis or the reduction in value. So his deductible loss is zero. His real loss is 80, but his deductible loss is zero. And of course, his tax savings is zero, which is his assumed tax bracket here of 25%. And that's just a number I've kind of pulled out of the air as kind of a reasonable average tax bracket. So Jack gets no tax savings whatsoever for this $80,000 loss of timber. Okay, moving on to the next slide, we'll have a little better information and a little better result for Jack, because when talking to Jack, we found out that he owns 3 additional tracts of timberland that sustained no damage and having an aggregate timber tax basis of $400,000. The block containing 4 tracts of land had an aggregate fair market value of $600,000 before the storm and an aggregate fair market value of $520,000 after, the difference being the $80,000 that he lost. Jack accounts for the 4 tracts of land as a single identifiable property, that's SIP. The SIP is comprised of 4 tracts of land, okay? Now, what's the rule? The rule is you get to deduct as a loss the lesser of, number 1, the timber block, not tract, but the timber block reduction in value, which is $600,000 less $520. That's $80,000. That's the real loss that Jack has suffered. That's one number. The second number, what is the timber block tax basis? We got $400,000 of basis available, okay? We get that because we are aggregating the 4 tracts of basis on 4 tracts, so that's 400,000. So we got our 2 numbers that we need. The timber block reduction in value of 80,000, that's first number. Second number is timber block tax basis, 400,000. So what is Jack's deductible loss? It's $80,000, which is the lesser of the 2 numbers. What is Jack's tax savings? We have to know his exact tax bracket, but here we're assuming 25%. If Jack's tax bracket is 25%, then 25% of 80,000 is $20,000. Those are real dollars that Jack gets to put in his pocket. And Jack might need that to try to get back on his feet after Hurricane Laura. the main thing to take from this slide is, in order to obtain the aggregate tax basis of that 400,000, which is the gateway to the deduction, in order to obtain the $400,000 of tax basis, Jack's accounting must show a single identifiable property as being all of his tracts, comprising a single block. The single identifiable property should include all 4 tracts. And for authority, you may want to look at Revenue Ruling 9956, which spells this out in great detail. But the bottom line is, by aggregating basis, generating more basis, we're able to deduct a greater amount of your loss. So that's something that, if I'm Jack, I want to seriously consider doing. Another example, totally different example. Bill inherited 80 acres from his parents earlier this year. Bill owns no other land. The parents' timber tax basis immediately prior to their death was 0. But the timber was valued at $2,000 an acre on the dates of their death. The step up in basis is $2,000 per acre, or a total of $160,000. Okay. After Hurricane Laura, the timber had 0 value and no salvage value and no insurance. So what's Bill's deductible loss? First, let's look at the reduction in the value of the timber. The reduction in the value of the timber is $160,000. That's $2,000 an acre times 80 acres is where we get the $160,000 loss. The stepped up basis here, because remember, this property just passed through an estate. And if it passed through an estate, Bill gets the benefit of that stepped up basis we were talking about. We're going to step his basis up to $160,000, which was the fair market value on the date of death. So he has a basis of 160. And what's the lesser of those two numbers? They're equal. The damage and the basis are exactly the same number. So his deductible loss is $160,000. And Bill's assumed tax savings here, same 25% bracket, 25% of $160,000 is $40,000. So Bill gets to put in his pocket $40,000. That's the deduction. The deduction is 160, but because of his tax bracket, he gets to carry home, if you will, $40,000. Now, question at the bottom of this slide is, assume that the parents donated the 80 acres to Bill just prior to their deaths. It's a very common thing, an occurrence in my office. People, elderly people, sometimes want to just give it away. They're close to death. They want to just unburden themselves with this property. So they have that strong tendency is sometimes just give it to the kids, so the parents don't have to worry with the management. By doing that, by pursuing that type of planning, the parents are giving up a wonderful opportunity to give the property to the kids with a higher stepped up tax basis. So I would encourage you to think long and hard about donating property just prior to someone's death. Oftentimes, if it's business property like this, we're going to have a huge tax benefit if you hang on to it, die owning it, and let it pass through your state, but achieve that stepped up basis. Stepped up basis is a wonderful thing, and it really saves the kids quite a bit of taxes frequently. Okay, that is the end of our presentation, and if we have any questions available, we'll be happy to attempt to respond to them. Buck, do we have any questions?
Paul, we do, and thank you very much for a very informative presentation. One question we have, is the deduction applied to all income or just capital gains?
If you're deducting this as a business loss, it's business property, then it's something called a net operating loss, and that offsets any other income. It'll offset salaries, dividends, rents, royalties. So it offsets any type of income. It's not limited just to capital gain.
Great. We have a question from one of our partners over in Texas. He says, will these rulings be applicable in Texas as well for hurricane damage?
Absolutely. The rules that we're talking about, the revenue ruling and the 2 court cases, they have nationwide application. So it's a federal tax law that we're dealing with. So they would apply in Texas just like they would apply in Louisiana or any other state.
Great. Another question we have is, would basis and value have to be allocated between land and standing timber in arriving at the strictly timber accounts?
The answer is yes. You need to account for your tax basis in your timber separate from the tax basis in your land. Those are 2 separate assets, and they need to be accounted for. The basis should be accounted for separately for those 2 different types of assets.
Very good. Another question we have is, can you discuss involuntary conversions? And I guess that question is in terms of tax or income.
Okay, well, involuntary conversion, the typical example of an involuntary conversion is the state comes along and wants to build a new highway, and they negotiate with me to try to buy my land for their right-of-way or their highway. And I say, no, I don't want to sell. They have the power of eminent domain. They can take you to court and force you to give over your property to them. If they do that, that's called an involuntary conversion. They've involuntarily taken your property. Now they're going to pay you fair market value for your property. And a lot of people think that, they shouldn't have to pay tax on the proceeds or the money that they receive in an involuntary conversion. But that is taxable income. Okay, you have to report that and pay taxes on it. Now, if you reinvest, if you take that money and you reinvest it in other timberland within a certain limited time period, you don't have to pay tax. Then your tax attributes, your basis gets carried over to that new tract of land. But involuntary conversions really don't have anything to do with hurricane damages. It's a separate concept, and it deals with involuntary conversions of your property.
Great. Can you aggregate tracts in different parishes?
Absolutely. It could be all the timberland I own in the state of Louisiana. Okay. So it's however, in the revenue rulings are very clear on that. It's however the taxpayer chooses to define the parameters. It could be 1 parish, it could be 2 parishes, it could be half a dozen parishes, it could be the entire state. It's simply a basket. You're defining the basket into which you're going to place all of your timberland in that defined basket.
What happens if you have 60 acres of, in this case, longleaf reforested timber that is about 5 years old that will need to be replanted? How does that work with regards to basis?
Well, you would have presumably some basis in those 5-year-old seedlings. presumably you paid someone to plant them. There may have been site prep expenses. So presumably the cost that you incurred is kept track of, and you have basis. So when those trees are destroyed, you would have that basis to apply against the loss. Yeah. That's one result that I could foresee. The other, perhaps more common result would be when those trees were planted, I probably took advantage of the rule that says I can deduct the cost of establishing those trees. There's a special code provision dealing with that allows me to deduct the cost of planting and reestablishing a forest. And if I've elected to deduct the cost, then I have no basis. So when those 5-year-old seedlings were destroyed in the hurricane, I have no basis and would have no deduction. So I can foresee two different situations. One where I have some basis, and the other situation is where I don't have any basis, and I get two different tax results, depending on whether or not I have tax basis in those trees.
Okay, here's a question that looks like we're getting into the legal ramifications a little bit. What if a parent owned land and died prior to hurricane, but succession was not done until after the hurricane? Can the tax basis still be used and figured the same way?
Good news. Good news is the new tax basis is established as of the date of death. The date of death, the value of the fair market value of that property as of the date of death becomes the new basis. And it may take a year or two before the kids actually get a piece of paper that say they own it. But in the meantime, whoever is in control or in possession of that property gets the benefit of the stepped up basis. Now, there may be an estate proceeding underway where the executor is filing a tax return. And in that event, the executor would take advantage of the stepped up basis. However, if the succession is now complete by the date of the hurricane, the kids now own it, the kids would have the basis that they could apply to generate the deductible loss. So I can foresee two situations. Number one, where the executor takes advantage of the stepped up basis, or number two, the kids, if they own the property at that time, they get the benefit of the stepped up basis. But the key thing to remember is, as of the date of death, the property gets a stepped up basis.
You talked about business owners and investors, and this next question deals with further explaining investment classifications and deductions. Are these situations where investment property damaged, are they deductible? Good
question. Think of our land in three different baskets. There are three baskets of investing. The first is what we call a hobby. If you're a hobbyist, you have no intent trying to make a profit. You simply enjoy watching your trees grow, or maybe bird watching, but there's no effort to make money off of your trees. The second category, or the second basket, would be people that invest money in land and just let it sit. And they don't pay any attention to what's growing out there. They're not trying to generate greater income from their trees. They simply bought that tract of land out in the boondocks with the intention of way down the road, perhaps at their retirement, it'll be worth more than they paid for it. Those people are what we call investors. The third category is people who buy land and have a profit motive in growing and marketing and making money off of growing trees. They have a profit motive, and they actively manage, either personally or through a forester or third parties, but they're actively trying to make as much money as they can off of growing trees. So those are our three baskets. Now let's think about if you have the first basket, you have a personal or just a hobby. If you're a hobbyist and your land is your trees are damaged or destroyed, and if you're a hobbyist, there is no deduction available. Second category, you're an investor. Again, you've got trees out there on that property you may have never seen, but you've got trees growing, and those trees were destroyed by the hurricane. Are you entitled to deduction? No. Why? Why are you not entitled to deduction? Because you don't have business property. You're not actively managing it. There's no profit motive associated with growing trees. So if you're an investor, by our tax definition of an investor, no tax deduction available. The best basket to be in would be if you are in the business of growing trees. If you're actively trying to grow more and better trees and you have a profit motive, you are in the business. So if you're in the business, then these tax rules we're talking about apply to you, and you can deduct your loss up to the extent of your basis.
Very good. Paul, an earlier question asked about bundling tracts in different parishes. This question is a two-part question, one dealing with can you bundle tracts in separate states, and second part of the question, must you separately identify basis for the land and the standing timber?
Based on my understanding of that revenue ruling, but of course, I want the listeners to understand that they need to consult with their advisor. But my understanding of the revenue ruling, it leaves it up to the landowner to design the bundling, and however the taxpayer designs the bundle, will be respected by the IRS. So if you have tracts of land in Louisiana and in Mississippi, or in any other state, or maybe multiple states, you get to, if you so design your bundle, and this is the key thing, you would have to make sure that you, with your tax advisor, bundle it in such a way that you encompass the tracts that you want to encompass. Then you get to bundle the tax basis in the timber. That'll be one number. And over here, another number will be your tax basis in the land. But these are aggregate numbers, aggregate tax basis in the block of the timber, and the aggregate tax basis you have in the land that's in that block. So ultimately we'll have two numbers. We'll have a total tax basis, an aggregate tax basis, and an aggregate land basis. Then as we experience hurricanes, or if we sell property, or we otherwise use our tax basis, we will adjust this aggregate number that we have for our timber basis. And we do the same with land. We keep track of that number, and if we sell property, that's going to carry out or reduce the amount of our land basis. So definitely we need to keep track of these two numbers. One, the timber tax basis, and secondly, the land tax basis in that block.
Okay. This viewer asks about, let's say they have 10 different tracts of different stage of management. Some might be small timber, some might be mature timber. Can you still bundle stands or tracts of different management regime?
Okay. Another warning here is all of these answers that I'm giving are contingent upon your tax advisor reviewing it with your tax advisor and making sure he feels comfortable with it. But my interpretation of the revenue ruling and the court cases is that the taxpayer can design the bundle however the taxpayer chooses in order to satisfy his management objectives. Whatever he designs is going to be binding. That's my interpretation of the authorities. But again, consult with your tax advisor before you go too far down that road.
I hope I'm presenting this question properly. Is there a reason to not put individual tracts in a SIP?
Off the top of my head, I can't think of any disadvantage. Perhaps in further thought I would, but right now I can't. It's usually to your advantage. As a general rule, it's to your advantage is to use your tax basis as soon as you can. The time value of money suggests that we use tax basis to offset income and to reduce taxes. When you reduce taxes, that is a utilization of the basis. And the sooner you do that, the better off you are financially. You put money in your pocket when you use your tax basis sooner rather than later.
Question back on damaged timber. Can you defer the income if you salvage some of that damaged timber? Can you defer the income as an involuntary conversion to be applied to a future purpose?
Not exactly sure. I'm not real clear what the questioner is getting at there. Let's defer on that question, Buck, because I'm not real sure I understand.
Okay. What is the tax ruling if the landowner is fortunate to sell some of the hurricane damaged timber? Looks like in this, you got the question.
A good question. If the landowner who sustained some damage to their timber, but it's not a total loss, they find somebody to come in and salvage some of the timber. The salvage proceeds, whatever money you get from that salvage operation, those dollars must be applied to your damage. So your damage would be reduced by the amount of the salvage proceeds.
Okay. Another question is, in your example, you assumed 100% timber loss, but in many cases, there's only a partial loss. Who decides the level of your timber loss?
Well, that could end up being it's a factual question. That what I would do if I had a situation like that, I would get with my forester, my consulting forester, and let him come in and take a look at my situation and give me his professional opinion. Do I have enough damage here to consider this a total loss? Or alternatively, is this a situation where we can go in and perhaps work on this tract of land, do some salvage, do some replanting, and maybe salvage some of the, or not salvage in terms of cutting and selling, but salvage the property in such a way that we've got some trees that are 20 years old that we are growing, and we got other trees out there that are seedlings. Does that make sense given the tract of land we're working with? If we can manage the two different ages of trees, if the forester feels like that would be the proper thing to do, then we would make a decision to follow that advice and to manage these two different aged stands. But usually in a situation like this, my experience is most foresters would say, let's just clean it, cut it, get whatever money we can out of it, and go back and replant so that we have a single age plantation would be typically what I would expect.
Back to one of our earlier questions when they were talking about their longleaf stand, 5 years young and destroyed. The question here seems to be, is there any way to capture the loss in growth and monetize the loss in growth in claiming a casualty?
Well, my appreciation of the question is we've got 5-year-old seedlings those seedlings have no marketable value. However, they have value. They have value, and it depends on how you estimate that value. Do you go back and take the costs that were incurred and simply accumulate those historical costs? That's one way. The other way is look into the distant future, theoretically grow that tree to maturity, and then discount it back to the current value. When you do that, oftentimes you get numbers that are theoretically they should be the same, but they're not. One of them is usually greater than the other. So I think the questioner is getting to the very real possibility of growing these trees theoretically and discounting them back to the current value. And that is certainly a well-recognized, acceptable way of valuing the loss, valuing the damage to this tract. So I think the questioner is onto a very good idea, is to try to value these trees based on growing them into the future and then discounting them back to current date value.
Very good. This next question, the questioner is a forester, and he wants to know, can he estimate damages on his family property and be recognized for assessing the damage?
I would think in most situations that would be okay. The argument or the pushback that you're going to potentially receive is go to an IRS audit or go to court and have your expert a family member, and the IRS on the other side of the table, they're going to argue that the estimate of value is no good because the forester is biased. He's a family member. He's obviously not objective. He has a bias. Therefore, we should not put too much credence in what he has to say. Now, that's assuming you end up with an IRS audit or going to court. Most cases never make it that far. What a lot of people would do would be to go ahead and use the family member as the forester, as the expert to evaluate damages. And then if you actually end up in an audit or end up in court, perhaps bring on another expert, someone who is objective, does not have those family ties, and can testify as an objective expert.
Very good. Another question, can the loss be deducted if the loss occurred during the time the purchase of a property was under contract, but the sale had not closed?
Off the top of my head, I would have to say probably not, because you're not the owner. You're not the owner until such time as you get a deed that says who the owner is. So during the contract period, you're just kind of working toward owning property. You don't actually own it. Only when you get a deed to it do you become the owner. So I think your tax benefits start to run from the date you acquire ownership, not the date you sign the contract.
All right. If the loss is more than this year's tax liability, can the overage be applied to future taxes?
Simple answer is yes. That's a good thing. Historically, go back a few years, you could take that loss, that excess deduction, and go back and recoup monies that you'd paid in prior years. That law was changed to foreclose that opportunity. But today, if you have an excess deduction over your income this year, you can take that excess, it's called a net operating loss. You can apply that net operating loss in future years indefinitely. There's no limit. So if you got a huge casualty loss, you're going to get the benefit of that over future years, and it will save you tax dollars every year into the future.
Another question is, if in a damage, the unsalvageable timber from a storm causes a southern pine beetle infestation that destroys the remaining timber stand, can the loss of the whole tract be deducted up to your basis?
Our questioners are becoming quite creative. I like their thinking. They're thinking about some very good concepts. If this second loss, the first loss was the hurricane. The second potential loss are the beetles coming in and infesting this residual property. The question would be, is the beetle a casualty loss? And remember, it has to meet those three magic words: sudden, unexpected, and what was the third one? Sudden and unexpected. There's a third one that I'm not thinking of right now. But the courts have held, some years ago, we had a lot of beetle damage. So the question was whether or not beetle damage meets the definitional requirements. The court, in at least one case, held that the beetle is a very, it's not sudden like a fire or a hurricane. A beetle acquires, beetle damage occurs over a long period of time, or a much longer period of time. So it did not meet the definitional requirements because it was not sudden enough. It was over a period of months, not a single day like a hurricane. So I think the courts and the IRS would take the position that your beetle loss cannot be used because it simply does not meet the definitional requirements for a suddenness.
Right. Another question I have is, this person inherited land and timber 20 years ago. The timber was given no value in the estate proceeding, thus they have no documented tax basis. Are they out of luck?
No, you're never out of luck. Here, what you can do is to get a forester, a consulting forester, who will go out, look at the property and give you his analysis and his opinion as to what the value and the volume of the timber was 20 years ago. Now, our foresters can do that. I know they can. And if they do that, they will give you a piece of paper, which basically is their opinion as to what that property, what its value was 20 years ago. That can be used to establish your new tax basis. You get a stepped up basis. Whatever that value was, your basis is going to be stepped up to it. Now, one precaution here, to be on the safe side, I'd get your lawyer to go into the estate proceeding and file an amendment to the judgment and show this new stepped up value. If you don't do that, you're going to run the risk of having some IRS agent looking for a value in the succession proceeding. It's not going to be there, and he's going to raise questions about it. So if you go back and amend those succession proceedings, you get the value put into the court records, and the IRS is more likely to accept what they find in the court records.
One of our astute viewers helped us out. The definition of a casualty loss is sudden, unexpected, and unusual.
That's it.
That's the word we were looking for.
Yes.
Unusual.
All three of those. And I've heard recently of some people say, well, the fact that Louisiana has all these hurricanes, which seems like we're having it one a week, so it's not that unusual anymore because we're having them weekly, it seems like. Well, don't worry about it. Courts have come to our aid. Courts have already held that if it's a hurricane, it meets the definitional requirements for sudden, unexpected, etc.
Very good. Some of the questions are, will there be electronic copies of the slides available? And this proceeding, this webinar has been recorded. So all of this will be on the Louisiana Forestry Association website, I would say by the end of the week. And if there are any questions, we will be happy to entertain them. But one final question. This viewer asks, could forest fires that result from LoRa also qualify for casualty loss?
Yes, if you have a forest fire that gets out of hand and burns your timber, that's an independent, totally separate and independent casualty. So you would view it the same way, but it's unexpected, it's sudden, and it burns your timber, and that's a loss. That's a casualty. You go through the same rules. What's the basis? What's the value, decreased value? Go through the same analysis to determine your deductible loss.
Very good. Paul, thank you for a wonderful presentation, excellent webinar. Want to thank everybody who participated in this webinar and for the very insightful questions. Again, please look at our website, www.laforestry.com, for updates on this webinar and recordings. And with that, we hope everybody is safe and healthy. Stay well, and thank you very much for your support of the Louisiana Forestry Association.